Good morning, students. My name is C. Gupta. Today we will be discussing on the topic of portfolio management. So let us start. First of all, let us start. What is a portfolio, right? Portfolio is nothing but a collection of securities. So, in a very layman terms, collection of securities is regarded as a portfolio. Now, think yourself as a portfolio manager. If you are a portfolio manager, what key things or what key decisions you will take while building your portfolio? The first question that comes to our mind is that which security we should invest, correct? Because if it is a collection of securities, we have to first identify that which securities we need to invest. Then second question that comes to our mind is that what amount of investment should I invest? Or let's say what proportion of the funds that I hold should invest. So what amount in that particular security I should invest. So if I have answer to these two questions, I can definitely form a portfolio. Now, once the portfolio is formed, correct? Once the portfolio is formed, even I have to evaluate the performance of the portfolio, right? So the third step in this would be the evaluation of a portfolio. Okay, students. So broadly in this discussion, in this chapter, we will discuss around these three steps only, which is we'll try to see that which security suits us the best, what should be the amount that we should invest in that security. After that, there is a portfolio formed, and how should we evaluate that portfolio in terms of its performance, whether it is doing good or whether it is not doing good. Now, as far as the security is concerned, let us try to deep dive on the first step. Now, as far as the security is concerned, there are many characteristics of a security, because now what we are trying to analyze is which security is best suited for us. Now, there are a lot of characteristics that a security holds. There are two most important characteristics which are relevant in a portfolio management, which is the first characteristic is what is the return, and the second characteristic, what is the risk. Okay. Now, let me explain them in detail. For a security, we need to see that how much return can we expect or how much return are we getting. Now, what is the return? Return is always expected in two forms. One is in the form of a capital appreciation, and second one is in the form of a constant stream of funds. For example, dividend in case of shares, interest in case of bonds, and rent in case of a land. Correct? It can be any investment for which we expect a similar stream of cash flows, right? So what I'm putting here is constant stream of cash flows. So these are the two things that any investor would expect out of a return from a security. One is he would want that whatever amount he's investing, it should appreciate. Second is there should be a constant stream of cash flows coming in. Here I'm putting, for example, dividend, interest, or rent. It can be anything. Now, if you see this concept itself gives us the formula for a return. So the return is calculated as the D, which is the dividend I'm saying, because here mostly we will talk about the shares as a security, plus P1, which is the price after 1 year, which is nothing but the capital appreciated value divided by P0, which is the price today, that is the investment that we have done, minus 1. This is a very simple and very basic formula that how to calculate return is that the dividend plus the price at the end of the year divided by P0 minus 1 will give us the return percentage. This will be the return percentage. Correct? Now, the returns can also be of two types. Not of two types, but there can be two forms of return. See, one is the actual return. And second one is the expected return. Let us first try to understand what is the difference between two of them. Before this, let me also tell you one fundamental concept, which is if you see any data, an arrangement of data, let's say a series of data, for example, share prices of any company. So it can take two forms. One is the historical form and one is the futuristic form. Correct? So historical, as the name says, it's between the history. Whatever has been passed as historical numbers, that will come here, correct? So it always deals with the actual data that has happened in past. Okay. And what is a futuristic one is? Futuristic is the data that is going to happen in future that we're going to estimate now. So it is the estimated data. Correct? Now, since this is actual, there is nothing wrong because already it has happened. But in case of estimated, we will deal with probabilities. Correct? So that means for futuristic, there is a probability involved. Always in the data set, there will be a probability involved. Now, why we want to differentiate between these two forms is because if there is a historical data and if there is a futuristic data, the treatment or the definitions will change accordingly. Okay. So let us keep this thing in mind and now come back here. Now, what we were saying here is that actual return is the return that has already happened. Okay. Or that already the stock is giving us, or let's say already the security is giving us. That is the actual return. So this is this I can say is already happened, which is the actual. Now, what is expected? Expected in case of two series of data, which is again the historical and futuristic, if I can say. So expected return in case of historical data is nothing but the simple average mean. That's all. Simple mean. Simple mean, because if you are given a data of last 10 years of a security in terms of a return, now you know that, okay, in 1 year the return is 10%, in next year the return is 12%, in third year the return is 11%. So for me, the best way to expect a return out of that 10 years data for that particular security is I will take a simple average mean and I will say that next year going to come, most likely the return is going, the most likely expected return should be this, correct, which is the simple average. Now, in terms of formula, if I say expected return is equal to summation of I is equal to 1 till n, x1, x2, xn divided by n. This is the simple average. Correct? In case of historical data, because there is no probability, there is nothing, the formula is not complicated, formula is very simple. We have to take simple average mean to derive at what return we can expect in the time to come. Now, in case of a futuristic data, since it involves probability, so here the expected return will also change, will also adjust itself according to the probability. So now what we have to do is, we have to take a weighted average basis the probability, because we are given in future there is a 10% probability of this thing to happen, there is a 20% probability of this thing to happen, like that there is a total 100% probability for different things. Now to see that what is the best expected return out of it is just to take a weighted average and weights being the probability. We'll just see in the questions also to come how to calculate it. But as of now, as far as the formula is concerned, so it will look like this. Xi is nothing but the return for particular probability multiplied by the Pi, which is the probability of that return. I is equal to 1 to n. So whatever are the number of observations, we have to multiply them and take a summation of it. Okay, students. So this is the expected return in case of a historical and futuristic data looks like. Now, with this, let us see the question number 1. The questions are already uploaded. So this is in the same sequence I am going to take. So question number 1 says, a stock costing rupees 120 pays no dividend. So it has cleared by itself is that there is no dividend involved and 120 is the current price. Okay. The possible prices, if you see the possible prices, that means the future prices are given that the stock might sell for at the end of the year with respective probabilities are. Now, since the probabilities are given, it's definitely a futuristic data, right? Okay. So these are the different prices and these are the different probabilities. It's a futuristic data and they're asking us to calculate the expected return as of now. So expected return for us, since it is a futuristic data and we know that it's a probability and hence we can use this formula to arrive at the expected return. Simple. Expected means what I can expect in simply in future. Correct? Yeah. Now, we can first of all say that expected return is given by dividend plus P1 divided by P0 minus 1. This is our expected return formula. So calculation of expected return. So why we have to calculate return first? Because the prices are given, right? Not the return is given. Hence, you have to calculate the return first. Out of those returns, we'll calculate the expected returns. Okay. Now let me take the prices. First of all, here 115, 120. Students, I would be very happy if you send some of the questions. So please don't hesitate. Please ask as many questions as you can. $130, $135, and $140. So these are the price notations that I have till now I have put. Okay. Now against these prices, applying this formula, the return percentage can be computed, which is minus 4.17, 0.00, 4.17, 8.33, 12.5, and last one is 16.67. So these are our expected returns calculated basis the formula above, which is in this case would be 115. For example, in the first case, I'm saying 115 divided by 120 minus 1. Minus 1. This is the first one, which is minus 4.17. Correct? Similarly for the other parts. So once the return is calculated, we will plot our probabilities that are already given in question. So 0.1, 0.1, 0.2, 0.3, 0.2, and 0.1. Okay. Then the probability and this return, if we multiply, we will get the weighted average of both of them. So this will become as 0.417, 0.00, 0.834, 2.499, 2.500, and 1.667. So this gives us 7.083 if we sum it up. So that means the expected return comes as 7.083 percentage. Here we have done R percentage multiplied by probability. We have calculated the weighted average here to calculate the expected return. I hope this question is clear. Now we have solved the first part. We'll see the concept of this second part and then we'll solve the second part later after this. Now, Sairam is asking, portfolio is also applicable in case of business and product. Okay, so let me answer this. So portfolio is, if you ask what is the word portfolio, portfolio is a collection of anything and everything. In case of a business, it can be portfolio of different businesses. For example, consumer business. For example, pharma industry. For example, the real estate business. There can be a bunch of different businesses put together and combined as a portfolio. There can be bunch of different products in a company that can be combined in a portfolio. Correct. For example, different product categories, it can be combined into a product portfolio. That is also a collection of products that is called as portfolio. But as far as our discussion is concerned, we are looking here portfolio from the form of investment. We are saying that in different securities we have to invest. For that, the portfolio we have to manage. And hence, this portfolio management discussion will be restricted to the securities, to the investment in securities. Okay. Now let us go back to the second characteristic. So the first characteristic of a security. Now, see where from I started is that which security we should invest. Now the security that we should invest is what we are evaluating currently. We have to evaluate on two parameters. What is the return and what is the risk? Now return, if I tell you that there are two securities, let me come here. So there are two securities, for example, security A and for example, security B. Now, if I tell you that there are two securities for which the return of security A is 8%, but return of security B will be is 10%, correct? So, in which security would you invest? In which security would you invest? Is it security A or security B? Or you need some additional information to conclude that which security is better? So whether this security A is a better one or B is a better one, or you need some additional information to gauge it that which one security is better. See, according to me, in this only returns percentages are given, right? We would also know that what is the deviation in these returns that can be expected. For example, now whenever we talk about the series of data, right, there are deviations, there are these means. Now what can happen is, since this is we have just calculated basis the averages, right? Let's say the mean. Now there is a chance that actual outcome will be different from the expected outcome. So for example, today we expect that the return is going to be 8%, but actually the return can be 11% also, or actually the return can be 7% also, or 6% also, correct? Similarly for security B also, it can be the same thing. So hence, there comes the concept of risk. Now, what is risk? So, risk is the deviation of possible returns from expected returns. So, whatever are the different possible returns, wherever they deviate from the expected return, we have to calculate that degree of deviation, that what is the quantum of that deviation, right? Now, if you see, as I told you that it, instead of this 8%, it can be 11%, it can be 5%. Here also, this 10%, it can be 11% or 9%. Yes. So Miss Bharti Taylor is saying we need to consider risk related, which is what we have discussed. Harshad is saying from return point of view, security B is better. That's right. But now if we add this risk concept here, so so that means we have to find a range. Correct. Now what is that range? I am saying that generally 8% is the average, but 5%, which is minus 3% here I am saying, and plus 3% here I am saying, which is 11%. So 5% and 11% becomes the range. So now how we can conclude this statement is security A on an average gives us 8% of return, but there are chances that the lowest return can be 5% and the highest return can be 11%. Now, has this improved our input in the decision making? Definitely yes. Now, let us see what security B says. So, security B says that on an average, it's 10%, correct? But there are chances of plus minus 6% here. Minus 6% plus 6%. So, here it can go up to 16%, and at a lowest level, it can go up to 4%. Now, don't you think that you can take a better decision making once you have this range of both the securities? You can make a better decision making, because now here the upper and lower range is 4% and 16%, but here the lower range is 5% and 11%. Correct. So this is what this plus minus 3%. Now you would wonder that from where I have taken plus minus 3% and plus minus 6% here. This is nothing but the risk. This is nothing but the risk, which is called as standard deviation. So this is actually arrived from the formula of standard deviation. And if I conclude from this statement also, correct, I am saying let's not go to the standard deviation formula at all. Let's see what the statement says. Deviation of possible returns from the expected return. That is what the risk is. Correct. Now, if I put it in such a manner that, so this is, let's say, the different possible return, xi minus x bar. X bar is what? Our mean, which is nothing but this expected return that we have calculated here or here, wherever it is. So it is the deviation from the expected return. Correct. Now we have to put a square here, divide by the number of observations and take a summation of it. This will give us the standard deviation or the deviation for the different possible returns deviating from the expected return. Now, the question that will come to our mind, why we have put a square here, correct? Now, if we don't put a square here, so there will be some positive deviation, there will be some negative deviation. What we are trying to calculate here is what is the extent of deviation, correct? Even if it is negative 3 or if it is positive 3, the extent of deviation is 6, correct? It's not plus 3 minus 3 netting it off. So hence, this minus 3 also as a square we have taken, and plus 3 also as a square we have taken, and then we have added it, so that we get the right extent of the deviation. Correct. And this is still not standard deviation formula. This is a variance formula. So this is the standard deviation sign that we use, correct? And square means the variance. So currently this is a variance. If we have to calculate the standard deviation, we have to take a square root here. Okay. So this is what the risk is or the standard deviation is. This now, after solving this, this will give you whether it is plus minus 3%, plus minus 4%, plus minus 10%, what is the risk associated with the security. Now, students, if you note in this also, I have not used any probability till here, correct? So that means I am talking about historical data here, correct? So if you see return also, this is the historical data, and for this historical data, this is the formula for calculating the standard deviation. Now, coming to the futuristic data, okay, so this is the first formula. The second formula, in case of a futuristic data, we need, instead of dividing it by the number of observations, we always multiply it with the respective probability. So in this case, the variance, correct, or the square root of variance, which can be the standard deviation, will be 1 till n xi minus x bar. This deviation will be the common one, taking a square and multiplying it with the probability of xi. Okay, again here we are taking square because we have to calculate the extent of deviation without ignoring, by ignoring the negative or positive sign, without giving any relevance to it, because if we take it negative, the deviation will become small, but that's not the case, because negative deviation is also a deviation, correct? So this gives us the formula for risk, which is nothing but the standard deviation. Now let us come back to our question number 1. So question number 1, we have calculated the expected return. The second part, it is asking us to calculate the standard deviation of returns as well. Now standard deviation, we have seen that in case of probabilities, the second formula that we'll have to apply. For that, we have to first calculate here. See, we have already calculated here the x bar, correct, which is the mean. Now we have to calculate xi minus x bar here, correct? That's the first step. So if we see, where is the normal x? Yeah, so minus 4.17 minus 7.083. Okay, so this comes as minus 11.253. Then 00 minus 7.083 comes as minus 7.083. 4.7 minus 7.083 comes as minus 2.913. Then 1.247, 5.417, and 9.587. And here we will just take the value, squaring it, and multiply it with the probability, correct? So taking a square of this and multiplying it with probability. Okay, so this comes as 12.66, 5.017. Now students, you note why I was saying for square. If you see, this is a negative deviation, correct? But the negative deviation is also reflected as a positive because of the square. That will give us the true extent of deviation, correct? If we take these negatives and add into positive, some lower number of deviation will come, which will not be the right picture, correct? 1.698, 0.467, 5.869, 9.191. So this gives us the total of 34.902. So this is what the standard deviation, for the purpose of calculating standard deviation, is. So we have already seen, I'm just writing the formula again back here, xi minus x bar square probability of xi. Correct? Hence, the standard deviation square, which is the variance, is coming out to be 34.902. We have to take it a square root to arrive at the standard deviation, 5.908 percentage. So, students, you would have noted that once you take a square root, you always put plus minus, correct? Because for minus 5.908 also you will get this value, and plus 5.908 you will get this value, correct? And hence, this is the same thing that I was trying to tell you, which is that plus minus 3% or plus minus 6% in our earlier example of security and security B. So now what does this entire thing means? Now let us connect the dots here. Expected return is how much? 7.083 percentage. Now it can go down by minus 5.908 percentage, and it can go up also plus 5.908 percentage. Now this is what the lower and higher brackets can be. Now this gives us better facts from the security point of view to take any decision, whether we should select that security or not. I hope this discussion is clear in terms of what is the concept and why do we need standard deviation, what is the relevance of standard deviation, and in different situations, how does it looks like? For example, in case of historical data and in case of futuristic data. Okay. Okay, now let us take our discussion onward from here. Now, if you have any questions, students, again, I'm saying please do ask anything, everything. Don't hesitate. Okay, now coming to the next part of the discussion. Now let us take the risk parameter forward. Okay. Now, while analyzing the risk, okay, we have to understand that first of all, the risk, the statistical definition is standard deviation. The conceptual definition also we have seen that it gives you a range, or let's say it gives you that the averages can go maximum up to what, and it can go minimum up to what, correct? It will give you that range. Now, if you see what are the factors that causes risk, now we have to see it from that angle that in future, the possible prices are changing, correct? Compared to the expected price, what factors are causing that? Now, the factors we can broadly classify into two parts. One are the systematic and second one is unsystematic. Okay. So systematic, as the name suggests, is due to the system, is due to the economy, is due to the macro factors, right? Is due to the generic factors. So I can say that these are the generic or macro factors. On the other hand, unsystematic is the specific / micro factors. Okay, students. Now let us give an example. For systematic, first example is the interest rate. Now, for example, the interest rate increases. There is a general impact on the returns of all the securities, correct? It's not that only one security is going to get impacted, it's that all of them are going to impacted in that particular economy. And also we know that interest rate have an inverse relationship with the prices of the security. If interest rate goes up, the prices of the securities goes down. Similarly, if the interest rate goes down, the prices of the securities goes up. So there is a inverse relationship with the security prices. Correct? This is what the systematic factor for a risk is. Now, second one is the market trend. Now, if market is bullish or bearish, it will impact along with that bullishness or bearness, the entire, the all the securities that are there in that particular market. Similarly, purchasing power, or we say it as inflation. Inflation is one of the factor which influences all across the prices of that particular economy again. So these three factors will have a generic impact on all the specific, on all the companies. Now, unsystematic means this is specific to a company for which the security we are dealing with. Now, for example, there is a business risk. Now, what is a business risk? That whether the business will grow or not in future, whether the margins profile of the business will remain intact or not, so that the bottom line of business is getting generated. Correct? So that is the business risk. But this is specific to a particular business. For example, there is a company called A Limited. Okay. Now the business of that A Limited is going through a tough phase. Thus, the security of A Limited will only be impacted. The security of B Limited will not be impacted because of this. Correct? Hence, this is a very specific risk specific to that particular security. Okay? This is the business risk. Then there is also one other form of risk, which is the liquidity risk. Now, a lot of businesses borrows money. Now, borrowing money means that you have to pay the interest as well as the installment of the principal whenever it is becoming due. Now, if there is any probability that you don't get enough cash flows to pay these obligations, then that becomes again a liquidity risk at your level. But that is again specific to a company, not for all the other companies also. Now, if you see, how does it relates to what we are studying, which is the portfolio management? This is just a simple thing that we are saying that, okay, there are certain factors that impacts all the companies. There are certain factors that only impacts the specific companies, correct? Now, if you see these factors or systematic risk, you cannot do much about it. That is not in your hand or in your control as a portfolio manager to avoid this risk. Because this risk is still there for all the securities, right? Because this risk is governed by the economy in which you are operating. This risk is not governed by the company that you are selecting, right? So hence, this impacts all stocks. So impacts all securities. But as far as this is concerned, which is the unsystematic risk, it only impacts the company specific returns, correct? Company specific returns it will impact, and hence there is a possibility to diversify this risk or to reduce this risk. Hence we call it this as a diversifiable risk. Now, portfolio manager thinks that this unsystematic risk is specific to a company. Now, I have to find such a combination in such a manner that can I reduce this unsystematic risk? Because in an economy, one's profit is another one's loss. So I should invest tactically in such a case that the two companies moves in the opposite direction. If there is a loss to this company, there should be a gain to this company, and again it will net off so that my overall unsystematic risk is zero. So that this business risk and liquidity risk can be managed. Now we will study this further. What is the exact technique to diversify the risk? But just to show it on the chart also, so that it's very clear to us. If we plot number of securities here, okay, let's say we have 1, 2, 3, 4, 5, 6, 7, 8. So we are saying that as the number of securities increases, okay, and here we can plot the risk, which is given by the standard deviation sign, okay. So as the number of securities increases, your risk will decrease, correct? That is what the basic essence of a portfolio management, right? Because through portfolio, you're trying to increase the return and reduce the risk. That's what the basic objective of a portfolio is. So the risk will keep on decreasing, but it will not be zero at any point of time. Why? Because there is a systematic risk involved here. So this all is the systematic risk, and these all are the unsystematic risk. Now, the point what we are trying to make here is that unsystematic risk will go off once you increase the number of securities. So there will be unsystematic risk reduction, and hence overall portfolio, the risk will also reduce. But systematic risk will still be there because you cannot eliminate it. That's a risk that all the securities are carrying. Okay. So just register these two terms in your mind. One is systematic and another one is unsystematic. Systematic is the generic one which cannot be diversified at all because this is a risk that is there with all the securities. But unsystematic risk, on the other hand, is a specific micro risk which can be diversified, because if we increase the number of securities in such a way that the companies are related in such a manner that the movements are opposite, in that case we can reduce the unsystematic risk of one company with the another company. Okay. Now let us go to the other two things that I wanted to touch upon. Now this is the clear definition between systematic and unsystematic. Now let us take our discussion forward. Now there are two terms. One is the variance, and second one is covariance. Correct? Now these are again two terms from the statistical measures, right? But let us see what does these means and how does we borrow some of the concepts in the portfolio management from these two things. Now variance, I have already told you, it's a standard deviation square, correct? We have already seen how it is calculated. What I'm trying to make a point here is that variance calculates the single series data related variances, correct? For example, X limited. So what is the deviation within X limited? It will give and calculate and give it to you. Now, what is the covariance is? Covariance measures the deviation of X limited with Y limited. So it's a more than one series data. So it will measure X limited with Y limited. So it will measure X limited with X limited only. This is X and this is Y. Okay. So X with X and covariance will measure the X limited with Y limited, that what is the joint variability in a particular series of data. Okay. Now, if you see formula also, we can just derive it from here. Summation of X minus X bar square divided by N. That was our historical data. Here it was X minus X bar square and the probability of X. That's what we have discussed in the futuristic data, correct? These are the two formulas. Now the covariance, for covariance, we have to define like this. So the same standard deviation sign, but between x and y is given by summation of x minus x bar, which is the first series. Instead of taking a square here, we multiply it with y minus y bar divided by n. Okay. And for futuristic data, it will be summation of x minus x bar, y minus y bar, and will multiply with the probability of xy. So instead of in variance, since we have to calculate the deviation of the same series with the same series, hence we are taking a square and calculating it. But here in the covariance, we have to calculate the variance of one series with respect to the another series. Hence we are multiplying deviation of x with deviation of y to arrive at that what is the total deviation between both of them jointly. Okay, so this is again, register these two terms again in your mind. One is variance and one is covariance. Now let us understand one more thing. There is another term called coefficient of correlation. Correlation coefficient, we can say. Correlation coefficient. This is denoted by R, again in the statistical language. Now, this R is what? Correlation coefficient is what? It is always in the range of -1 to +1. Okay. Now, what does this mean? So, correlation coefficient measures the degree of relative movements between two series. Okay. Now, for example, we say that R is equal to -1. For example, okay. Now, if we say that R is equal to -1, I am taking two series here, X and Y. So, for example, X is in the pharma company, pharma sector, and Y is in medical insurance sector. Correct. Now, can you say that if the pharma increases, I'm trying to say that if the pharma's business increases, definitely the medical insurance business will go down. I mean, their profitability will go down because they will have to process more claims. Correct? Understand it from that side. So these are two different industries, but both of them are negatively related. So this negative one means if the pharma goes up by +5%, insurance will go down by -5%. Can you see the relevance of this -1? The -1 correlation coefficient between X and Y, it denotes that both of them move equally in the opposite direction. Both of them move equally in the opposite direction. This is what -1 is saying. If it is -5%, it will be +5% here, correct? Now, what if R is equal to +1? Now, in case R is equal to +1, it says that both of them will move in the similar direction. Now, imagine X is still a pharma, but Y is, let's say, a starch company, right, which manufactures starch and gives it to pharma to be put into the medicines. Correct. So if pharma increases, starch will also increase because as an input, pharma will purchase a lot of items from starch companies, right? So hence it is +1 means if it increase, this will also increase with the same extent and in the same direction. Similarly, if pharma decreases, they will purchase less and starch also will decrease. So R is +1. +1 means again they are moving in the same direction with the same extent. Okay. And if R is equal to 0, which is the correlation coefficient, if it is 0 between X and Y, okay. Now, if you can imagine any unrelated combination here, for example, X is pharma and Y is actually a consumer electronics. Both of them are totally unrelated industries, right? So if it increases by, let's say, 5%, it can go in any direction. It can be plus minus 7%, any number that you can think. There is no relation at all between both of them, between x and y, and hence r is 0. Okay, students. So I hope this r is equal to -1, +1, and 0. We know that what is the relevance of these three things in our parlance, right? So +1 means that both the series will move in the same direction and the extent also will be same. Direction same and extent also same. Okay, here extent is same, correct? So extent is +% -5%, but direction is opposite. If pharma goes up, insurance will go down, correct? So hence I'm saying that there is a negative correlation, with hence it is -1. So direction is opposite, direction is not same. For r it is same, +1 it is same, r is equal to 0. There is nothing, there is no relation at all. It can move in any direction. I hope R meaning is clear. Now how to calculate R? So R between X and Y, okay? Because always it is in relation to two securities, correct? The correlation coefficient is in relation to two securities. Hence R in relation to X and Y is given by covariance of XY divided by standard variation of X, standard deviation of Y. Okay, Namita is asking, sir, R can be other than 1, like 2, 3, 4? No, R can only be 1. Maximum, as I told you, within this range only R can be there. From -1 till +1 only it can be there. And why? Why it is there? Because of this formula. This formula says that for calculating the R, you have to take the joint variability between X and Y and divide by their respective individual variability, X and Y, which is this covariance, which I explained just a minute ago. Because this covariance will give you that what is the extent, correct? What is the extent? Again, I'm saying, because see, don't confuse standard deviation, variance, covariance, and correlation coefficient. All four of them are very different in their all the meaning. Now let me take that. Now see, standard deviation, variance, covariance, and correlation coefficient. I'm just putting R because R from today onwards for us is correlation coefficient. Okay. Now SD and variance, if you see, these are just square roots of each other, but this measures, what does this mean is, measures the extent of deviation in one series. Covariance measures the extent of deviation in two series, correct? And R measures the degree of extent. What is the degree of that extent? Whether it is +1, -1, between them, what is the degree? Correct. Whether it is 0.7, 0.5, 0.3, -0.5, -0.3, -0.7, like that. Okay, so this measures the degree of extent, this measures the extent itself, and this also measures the extent but in one series. I hope I am clear. Students, please keep on interacting. Please keep on sending the questions, queries in your mind, or even if I'm asking something, please keep on responding on the handle so that I know that we are connected. Okay. Even if I ask something, you can also respond so as to make this session a very interactive one. So this is what the standard deviation, variance, covariance, and R specifically means. Now let us see the question number 2. Question number 2 says that, now students, if you see, we will connect all our dots, the different concepts that we have studied till now. See, I have told you that there are always analyze your data from two sets. One is the historical and one is the futuristic. Now, this data is given in the historical sense, right? So, our mind should start thinking that in this question, there is no probability that is required. There is no probability related formulas that is required. There is just simple averages, simple mean, simple average. The historical rate of return of two securities over the past 10 years are given. So this has already happened for the past 10 years. Calculate the covariance and correlation coefficient of the two securities. See, covariance also we have just studied now, and correlation coefficient also we have just studied now. So let us first put what is the covariance. Covariance between, let's say this is X and this is Y. These are two securities, X and Y. So it will be given by X minus X bar, Y minus Y bar divided by N. This is what the covariance is, and taking a sum here. Correct? Why I am dividing by N is because this is a historical one. If there is a probability, I would have multiplied it by Px, which is not the case currently. Okay, now let us calculate the, let me just put the data here first of all. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So plotted 10 years here. Now let me plot the X, which is the first company's, the security one return percentages here. $14, $16, $15, $18, $20, $16, and $22. This is for X. Now, can we calculate the X bar first? Because that's a very easy thing to do. So we can just take a sum of all this, correct? For the X1, it comes as 148. Now, if X bar will be 148 divided by 10, correct? This is simple average, 14.8. Now, 14.8 is X bar. So now our next series, can we put here X minus X bar? Correct? So this will be minus 2.8, minus 6.8. So this will be calculated out 12 minus 14.8, 8 minus 14.8, 7 minus 14.8, correct? So that is how it is getting calculated. One 1.2, 0.2, 3.2, 5.2, 1.2, and 7.2. Now X minus X bar square, okay, will be the square of this number, correct? This is given as 7.84, 46.24, 60.84, 0.64, 1.44, 0.04, 10.24, 27.04, 1.44, and 51.84. The total here comes as 207.60. Okay. Now, this is the summation of the X minus X bar that we will use to calculate the standard deviation of X. Now, standard deviation of X will be given by 207.60 divided by 10, correct? Which is 4.56. So this is the standard deviation of X. Now let us calculate Y minus Y bar. Okay, first of all, we have to put the y series here. Y is 20, 22, 24, 18, 15, 20, 24, 25, 22, and 20. So the total here is 210, correct? Y bar comes as 210 divided by 10 is equal to 21. This is the y bar, which is the y mean. And now let us calculate the y minus y bar. So 20 minus 21 is minus 1. 22 minus 21 is 1. 24 minus 21 is 3. Similarly, minus 3, minus 6, 1. So this is minus 1, 3, 4, 1, minus 1. And here we have to calculate y minus y bar square, which is square of minus 1 is 1, 1 is 1, 3, 3, 9, 9, 6, 6, 36, 1, 9, 16, 1 and 1. The total of this is 84. So standard deviation of y becomes 84 divided by 10 square root, which is 8.4, square root is 2.90. And lastly, for calculating the covariance, we have to see the joint variability, correct? X minus x bar, y minus y bar. Correct? Because we have seen that covariance is given by this formula, which says x minus x bar, y minus y bar multiplying and dividing it by n. So let us calculate this from here. 2.8, 6.8, 23.4, 2.4, minus 7.2, minus 0.2, 9.6, 20.8, 1.2, minus 7.2. The total here is minus 8. Okay. Now covariance between x and y is minus 8 is the total divided by 10, which is the number of observation, becomes as minus 0.8. And r is minus 0.8, which is covariance divided by standard deviation of x and standard deviation of y. 4.56 multiplied by 2.90, which comes as minus 0.0605. Okay. So the R is given as minus 0.0605. This is what R is. So if you see again, R is between the range of minus 1 and plus 1. Now what we conclude here from this is that since it is skewed towards 0, this R is most towards 0, right? 0.06. It's almost 0. So we can say that both of them are quite unrelated in the way that both of them are moving in terms of the return percentages. Sometime it is going up, the security X is going up, security Y is going down. Sometimes security X is going down also, then Y is also going down. So there is no correlation between both of them. Hence the R is close to 0. So this is the table. So this, till now we have seen that how to calculate the covariance and correlation coefficient and what is the significance of both of them. So very important to understand that R is correlation coefficient that is used to determine how two stocks move in relation to each other. Correct. Now let us come to the application part of it. Okay. Now, if you see, there is a term that we have told, there is called a systematic risk. Correct. Now, this term we have used earlier. Okay, Namita is asking, explain how we calculate standard deviation of X. So standard deviation of X we have calculated is, first we have calculated the X bar, correct? Which is, we have taken the 148 total, divided it by 10. We have calculated the X bar, which is 14.8. After calculating X bar, we have find out the deviation of X bar from each and individual X series. So this first is 12 minus 14.8. 8 minus 14.8. This 6 point, minus 6.8 is coming like that. And then 7 minus 14.8 minus 7.8. 14 minus 14.8 minus 0.8. Correct? We have calculated it, taken a square here of these values, individual values, then taken a sum of that square. So 207 we have taken here, dividing it by 10 and taking a square root. Because see, what is the formula of standard deviation says? It says x minus x bar square divided by n, taking a under root. And here it is a summation also. Correct. So this is the summation. X minus x bar we have already, square we have already taken as 207, dividing by 10 and taking the square root. Okay. Now I was saying systematic risk. What is a systematic risk? We have already studied. Now systematic risk is caused by a lot of factors which are generic in nature, which are macro in nature. Now so there is a term called beta, is denoted by B. This is a factor that is used to calculate the systematic risk. See, this is not equal to systematic risk, first of all. Okay. So beta is not equal to systematic risk. Beta is a factor used in calculation of systematic risk. Okay, beta is a factor used in calculation of systematic risk. This is very important. Please note this point. And what is now beta? This is just a normal language, I mean a normal definition. Now what is beta? Beta is a sensitivity of returns of a security in relation to market. So in this we study that how the returns of a security is related to the returns of the market. What is the sensitivity of it? Okay, we'll study further on this. Now Namita is asking that how do we interpret R of minus 0.0605. Now Namita, just to answer your question, since R is equal to minus 0.06, so it is very close to 0.00, correct? If I put this is the line, so this negative 0.06 will come somewhere here, correct? 0.0605, which is almost close to 0. That means if it would have been minus 1, so that means there have been a perfectly negatively correlation. Perfect negative correlation is minus 1. Perfect positive correlation is plus 1. No correlation is 0. Hence, this we would have told that there is no correlation in this. Hence, this R, if you see in the series, it's there is no correlation. Now see, it is going down, it is going up, it is going down, it is going up. Now, but the extent is also not related. Now here, if you see, it has gone down by 4%. Here it has gone up by 2. Here it has gone down by 1, but still it has gone up by 2. Now it is going up by doubling, it is going down. Correct. So there is no relation as such to the extent and to the movement both. Direction and movement both. Hence, we can say that these both are not related. Correct? Both of them are not related. R is 0. Now coming back to beta. Beta, I was saying that beta is a factor that is used in calculation of systematic risk, number 1. Number 2, what is beta? Beta measures the sensitivity of returns of a particular security in relation to that of a market. Correct. Now, for calculating beta, Okay, now let me first explain it with an example. For example, beta is 2. That means if the market returns are moving by 10%, the security return will move by 20%, which is 2 times market returns. Similarly, if market return is going down by 5%, security return will go down by 10%. So that's why we say that beta is a factor that is applied to the market returns to arrive at the security returns. Correct. Although that is not a security return, but I'm saying that is a again factor used in the security return. Now, how to calculate beta? Correct. Because conceptually we have understood that beta is nothing but the sensitivity of returns. Now, for calculating this, there are two methods that are there. One is the correlation technique, second one is the regression technique. Now, students, please listen to me very carefully because now I am actually taking the inference from the earlier concepts that we have studied. I'm taking those conclusions and applying it here. Now, if you see, there are two techniques to calculate the beta. Okay, now let us first concentrate on first technique, which is the correlation. Now, what is a correlation technique? Correlation is nothing but a study of the movements of two series, correct? So let's say you have A and you have B. There are two data series. Okay, let's say I'm denoting it with X and Y. I'll take the consistent example, which I'm taking earlier also, right? I will take X and Y. So X, let's say, is a return on security, and Y is a market return. Okay, so first of all, do you understand that while I say there is a market return, what is that? See, there is a security and there is a market. Security, well, whenever we talk about security, it will be one. Market means that the entire economy put together, entire share market put together. Let's say there is BSE, NSE, right? Those are two different markets. But in that, all the securities are pulled together to arrive at that market. Correct? So market is the pool of all securities. That is market. Okay. Now what we are saying is that if Y is a return from market, X is a return from security, we have to study how both of them are moving. We have to take their past historical data of, whatever 20, 30 years, and then we have to do some rigorous analysis, come out that what is it that it is coming out to be in terms of both the movement. Now, the formula given under correlation technique to calculate beta is we have to take correlation coefficient of X and Y, which is the security and market, calculate the correlation coefficient and take it, multiply it with the standard deviation of X and divide it with the standard deviation of market. This is security and this is market. So this is security and this is market. Okay. So what they say is that you have to first take the correlation coefficient between X and Y, multiply it with the standard deviation of security and divide it by the standard deviation of market. And this is the correlation coefficient. Okay, students. So this is the correlation coefficient. And I can also write this formula, or I can write this formula in such a manner that beta is equal to covariance between X and Y. If I just put instead of RXY, see RXY is also calculated from covariance only, right? This one, RXY is calculated from covariance XY divided by standard deviation of X and standard deviation of Y. So I'm replacing this there, divided by standard deviation of X, standard deviation of Y, and this whole multiplied by standard deviation of X and whole divided by standard deviation of Y. So this, if we cut it, cancel it, so it becomes covariance xy divided by standard deviation of y square. That is variance of market. Now this is what? Covariance of security and market. This is variance of market. Okay, students. So this is the variance that is there in the market. This is the second formula under the correlation technique that we have derived. Okay. Now let us go to the question number 3. See, now question number 3 says the distribution of return of security F and market portfolio P is given as follows. Now in this also there is a security and there is a market. Now the probabilities are given. Okay. Now if we see our formulas for beta R everywhere, these are same only, right? Because only covariance will involve whether it is a probability or historical data, and hence that treatment will differ. Okay. Now there is a probability that is given, returns on security is given, return on market is given. Now they are asking us to calculate the expected return, which is nothing but the mean that we have already calculated, that we have already understood, of security F and market portfolio. Both of them we have to calculate the mean. Then they are asking us to calculate the covariance between both of them and then beta. Okay. Now Namita is asking, are these variables we calculate in practical life also? Yes, very much. Practically, to calculate the beta, the same correlation variables are calculated. The correlation coefficient is also used. So we do definitely make use of it. Now, let us calculate the expected return first. So here I am putting the probability 0.30, 0.40, 0.30. So the return in F security is given as 30, 20, 0. If we multiply it with the probability, okay, it will give us the expected return. 30 into 0.3 is 9. 20 into 0.4 is 8, and then 0. 17. Then return of portfolio of market minus 10, 20, and 30. This is these values that I have noted there. Okay. Now, market return multiplying with the probability, we will get as minus 3, 8, and 9. So the total is 14 here. So the expected return for F security is 17. Expected return for market portfolio P is 14. Correct? This is now what we have calculated. Now the second part of the question is also asking us to calculate the covariance. Now covariance is given by, in case of a probability, it is given by the deviation of possible return from expected return, which is RF minus RF bar, multiplying it with RP, which is the market portfolio deviation, which is RP minus RP bar, and multiplying it with the probability. So let me put it here, RF minus RF bar. So which is 30 minus 17, correct? 30 minus 17 is 13. Then 20 minus 17 is 3. 0 minus 17 is minus 17. Similarly, RP minus RP bar, which is the market, this is the deviation of market now. So this will be calculated as minus 10 minus 14, minus 10 minus 14, which is minus 24, minus 20 minus 14, sorry, plus 20 minus 14, which is 6. Then plus 30 minus 14, which is 16. Okay. And now in this, we are multiplying both of them. So let me just do it like this for the ease of reference. 1, 2, 3, 4, 5, 6, and 7. Now we have 7 different columns here. Okay, 7 different columns here. So the covariance I'm calculating is 6 multiplying by 7 multiplying by 1. That is what the covariance is, right? This multiplied by probability. So this comes as minus 93.6, 7.2, minus 81.6. This is minus 168. So covariance between F and P is minus 168. Okay. Now, if you see the formula of beta, we can, since we have calculated the covariance, so we can use the covariance formula, which is covariance between FP. This one I'm saying. This formula I'm saying because we already calculated covariance. Rather than using the R formula, let us use the covariance formula because this is what we've already calculated in the question. So covariance between FP and variance of market portfolio, correct? So let us first calculate the variance of market portfolio. That will be given by 7 square multiplied by 1, correct? 7 square is the deviation here, correct? And 1 is the probability here. So this comes as minus 24 square multiplying by 0.30, 172.8, 14.4, and 76.8. The whole divided by 2, sorry, the total is 264. So 264 is the variance of market, correct? Hence the beta is given as minus 168 divided by 264 minus 0.636. This is what the beta is. Now what beta is denoting here is if the market goes up by 1%, the security will go down by 0.636%. This is what the beta in relation to the returns of a market says for a particular security. Okay, now, okay, so Namita is asking what is the meaning of market portfolio? Market portfolio, as I told you, it's a collection of all the securities in the economy. For example, BSE, NSE, those are market portfolios, correct? Because those have all the securities of the companies listed in them. Then Namita is asking RF bar is 17 plus 3. So why we are not dividing it by 3? No. So Namita, here if you see, definitely these are for 3 observations, but this is not a historical data. This, see, why, when you divide by the number of observations is when you're dealing in a historical data. This is a futuristic data, right? Futuristic data, if you have already multiplied it with the probabilities, the moment you have done it, that means you are already doing a weighted average, and hence there is no need to divide it by 3. We refer this formula where I have put specifically. Let us go to the first part. Yeah, this one. So this is the formula where you will divide by n, but if you're multiplying with probability, there is no need to divide anything because you are dealing in the futuristic data. Okay. So this is what the question number 3 was. Okay, students. Now let us go to the regression technique. I think the correlation technique is clear now in terms of the formula. Now we have in correlation technique, we have made use of covariance R, which is correlation coefficient, and we have derived beta because it says that let us study between the joint movements in both the series. Now regression technique, on the other hand, what it says is, it says that simply we'll take again X and Y. X is a security and Y is the market. Okay. If X is a security and Y is the market, then what regression technique says is that we will consider here the dependent and independent variable. Okay. See, this is the independent variable and here it is a dependent variable. So what we say is that Y can move any direction. Y is independent, correct? Y movement cannot be controlled. But X movement is dependent on Y's movement, correct? So X movement is dependent on Y movement. This is what regression technique, takes as an assumption. Now, once the dependent variable moves in relation to the independent variable, that study is called as regression technique. And using this, the beta formula will look like this. Summation of xy, that means x multiplying by y and taking a sum of it, minus n is the number of observations, x bar y bar, divided by summation of y bar square minus n y bar square. This is y. So now students, always remember in this formula, the denominator is always independent variable. Don't confuse it. Just remember this point which I'm saying is, see, because xy can take change in any form or mode, right? What I'm trying to say is that in denominator, always take the independent variable, which is y bar square minus n y bar square. This part I'm saying. And on numerator, it will be both dependent and independent variable, both of them. So hence I'm saying that y here is the stock market data basically, and x is the security data. Okay. This is what the regression technique says. So basically regression technique is still here. I'm just putting it like this so that there is a complete bifurcation. Okay. This is what the regression technique is. And with this, we have to actually note down one more point here, which is covariance between A and B. Till now, what we have studied, how covariance is calculated between A and B is A minus A bar multiplying it B minus B bar, right? The joint variability between both of them and dividing it by N. But there is another formula to calculate it. Beta of A, beta of B, multiplying it by the variance of market. Okay, I'll come to this formula, why this formula is derived, and this is a very useful formula. See, this relates beta of two different stocks to the covariance of both of them by adjusting the variance of market. Okay, how it is done here is, see the covariance of AB, beta A, beta B, standard deviation of M square. Now beta A I can write as covariance between A and M, covariance between B and M, this is for beta B, divided by standard deviation M square, standard deviation M square, and whole multiplying it by standard deviation M square. Correct? This is what we do. This I can cancel it here. And covariance of A and M is A minus A bar, M minus M bar, correct? Similarly here, B minus B bar, M minus M bar, whole divided by standard deviation of M square. This can also get cancelled because M minus M bar is the square only. Now what we are left with this, which is nothing but the covariance A and B. No need to remember this derivation, but I'm saying that both these things are related, correct? No need to remember this derivation again, and no need to uh, grasp it. But the only thing is, I want you to remember this conclusion, which is covariance between A and B is given by beta of A, beta of B multiplying by the variance of the market. We were discussing on the beta on the regression technique. We have just seen the formula and we have seen this final derivation on the covariance between A and B can be calculated using the beta A, beta B as well. Now Namita is asking, okay, for uploading the notes, I will come back to you because I think once the session is completed on the entire portfolio, I think then that can be taken up. How M minus M bar is equal to standard deviation M square 2. I think you are saying this one, correct? So actually, Namita, here I have not put the exact thing. So hence I'm saying that see A minus A bar, M minus M bar divided by N, it would be correct. Similarly, B minus B bar, M minus M bar divided by N. If you open this formula, then it would be exactly divide by N, and then whole divided by this one. Correct. Now, can I take this as a cancellation? I hope now it is clear to you, right? I have not taken divide by N here. That's why you're getting confused actually. Hence, I'm saying don't see on derivation, just remember the logic here. Okay. But this derivation also I have corrected, which is saying that divide by N, if you do, then only you can just cancel it with this, right? And within this, one N we used here, which is the final N will be used here, this one. One N will get nullified from the variance. Okay. Now let us go to the question number 4. 3 we have done already. Now let us go to the question number 4. The question number 4 says that the following information is available in respect of the Krishna Limited. Now, Krishna Limited 2012, 13, 14, 15, there are different years. The average share prices are given, dividends are given, average market index is given, and dividend yield. So this is data related to market. And these two columns are data related to security. Correct? Now, what they are asking us to calculate the beta value of Krishna Limited at the end of 2015. Okay. Now, beta, as we know that, is calculated. Now, in this case, see the earlier question, we have done it using the correlation technique. Now, in this case, let's apply and see the regression technique, correct? Although we can apply anything that suits us, but in this case, I am solving it through the regression technique. So, summation of x5 minus x bar y bar whole divided by summation of y square minus n y bar square. Correct? This is what the regression technique formula is given. Now, first of all, let's calculate of returns, because in this question the returns are not given to us as a ready-made form, right? So here then we have Krishna Limited and we have market portfolios, correct? Now for the year 2013, if you see, the question starts from 2012. But we can't calculate the return of 2012. Why? Because there is no base year. See, what is the formula of return is dividend plus P1 divided by P0. So for 2012, there is no P0. That means 2011 is not there. Hence, we can only start from 2013, take 2012 as base, which is P0. Okay. So this will be given as 253 plus 22 divided by 245 minus 1. So this is 22, this is 253. So this we are adding and dividing it by the base, which is 245. Okay, students. So this comes as 12.24 percentage. Similarly, for market also, 2130 divided by 2013. And dividend yield is already given here in percentage form. So there we don't need to add it here. What we can do is minus 1 plus 5 percentage on dividend yield, which is this one. Correct? So this will give us the capital appreciation. This is the dividend yield. There is a dividend percentage. So 10.81 percentage is the 2013 return. Similarly, 2014 and 2015, we can calculate as 16.13 percentage. Sorry. So 2014 comes as 32.41 percentage. And for market, it comes as 16.33 percentage. Similarly, for 2015, it is 16.13 percentage, and this is 16.79 percentage. Okay, students. So this is what the percentage is. So what I was saying is this is 2013, 14, and 15 data. Now within this, we have to compute the beta, correct? We have now calculated the different years percentages that are there. Now within this, the beta will be calculated basis this formula, summation xy minus n x bar y bar, this formula, right? So next step is computation of beta. Okay. Computation of beta. So for the market, so for the security, I'm denoting it by X, market, I'm denoting it by Y. 2013. Okay. 2014. 2015. 12.24 percentage. 32.41 percentage. 16.13 percentage. Similarly, here it will be 10.81 percentage. 16.33. This is as per what we have calculated above. 16.79 percentage. Correct. Now XY is given as just a multiplication between both of them. 31, 529.25, 270.82, and Y square is given as 116. So that means we are taking a square of this 10.81, which is 116.86, 266.67, and finally 281.90. Okay. So this comes as 665.43. The total of XY comes as 932.38. And also, since these are the X bar, Y bar also we have to calculate, the expected simply we can take a total and divided it by 3. Okay. So this comes as 20.26 percentage for X and 14.64 for Y. In this, we have just taken a total of these 3 and divided it by 3. So the beta here is, so now what is the beta? A summation of XY, which is 932.38 minus N. N is number of observation, which is 3 multiplied by 20.26 26 multiplied by 14.64, which is the X bar Y bar, which is these two expected, whole divided by 665.43 minus 3 multiplied by 14.64 square. Okay, because so now students here, please remember, I have taken here the base of market, correct? In denominator, it is all of market that is considered. 1.897 is the beta. Okay, so the beta is calculated as 1.897. Now the conclusion is, if market goes up by 1, the security prices will go up by 1.897 percentage accordingly. And similarly, if market goes down by 1, the security prices will go down by 1.897 percentages. Now, Namita is asking, please explain the market 2013, that is 10.81. Okay, so 10.81, see, if you see in question, we are given the average market index and dividend yield already they have given, unlike in this where they have given the absolute dividend. So what we have done here in this case is, we have taken just a capital, this is just a capital appreciation, this part, and this part is the dividend yield. Okay, so capital appreciation, we have taken that 2130 divided by 2013 is how much? Minus 1, that will give us the percentage terms, that what is the percentage terms, plus 5% for the dividend yield. That will give us the total amount on the percentages. Okay, students. So this is what the question number is. So question number 4 we have seen. Now let us come to the next step of portfolio. Okay, I'll just give 5 minutes or 2-3 minutes for you to write it. Yeah, so Namita is asking, okay, this is done. Sairam is asking, what about government bond rate? Okay, now Sairam, that's a good question actually. So if you see, as of now, I've not touched upon the government bond rates. So the second part of the question is saying the state your observation where the government bond rates will be used. But this part we will cover after doing the CAPM, which is the capital asset pricing model. Okay, student? Okay, Sairam. So why I have not covered it? Because this will be used in the CAPM part. So we will again touch back here. Namita is asking, sir, in beta calculation in denominator from where we write -3. -3 is the number of observation. If you see -3, n is the number of observation, this -3. Because there are 3 observations, 2013, 14 and 15. That's why. Okay. That's why we have taken 3 there. Okay, now let us go to the next step. See, students, if you see till now, we have studied on the security, right? What is the return? What is the risk? Within risk also, we have tried to see what is the systematic and unsystematic risk. Within systematic risk, how to calculate beta using the correlation and regression technique. Apart from this, we have studied covariance, variance, standard deviation, and the correlation coefficient and the uses of all of this. Now let us come to the portfolio situation. Correct. Now, till now we were all the discussion was around security, right? How the security return would be, how the security risk will be. Now let us try to see, once the portfolio is formed, how to calculate that what would be the portfolio return and what would be the portfolio risk. Okay. Now again, as we have discussed, for a security risk and a security return, this is a portfolio risk and portfolio return. Now, how to calculate this? We have already calculated the individual security risks and returns. that we are going to multiply it with the weights to arrive at the portfolio return. Now the portfolio return is given by summation of I is equal to 1 till n. This is the summation of individual observations. That means the individual unit of securities multiplying it with the weight of that security. Now, let's say there is a particular security that is invested as 30% of the entire portfolio amount in that security. So the weight will be 30%, and this is the security percentage of that particular security. So just to clarify, XI is equal to expected return on a security. WI is the weight of the investment. In a security. Okay, students. So this is very easy, very simple. We have to just multiply it with the weight and take it. So Namita, you are right. If Namita is saying that if beta is positive, then we can conclude that there is a direct relationship between the security and the market. That's right. So there is a direct relation, but the extent will depend on whether beta is 1, 2, 3. That will define the extent. But a positive will mean that there is a same direction correlation between both of them. Okay. Now, how to calculate risk? Now, students, if you see risk also, I am just putting it here because I need some bigger space. See, for calculating the portfolio risk now, correct? Now, there are different theories or different techniques again. This, first of all, we are covering the MPT, which is the Markovitz portfolio theory. MPT, or it is also called as modern portfolio theory. Okay. Now, what does this Markovitz portfolio theory says is, you have to analyze the situation again in two forms. One is in case of two securities and in case of more than two securities. So if your portfolio have two securities, then you will follow this method. If your portfolio have more than two securities, you will follow this method. Now, what are those methods? Okay. Now, in case of two securities, he is saying the formula is very simple. So the standard deviation or the variance of portfolio is given by weight 1 square standard deviation 1 square plus weight 2 square standard deviation 2 square plus 2 weight 1 weight 2 standard deviation 1 standard deviation 2 R12. So this is the formula. Now let me explain this. See, this is nothing but a square plus b square plus 2ab. Apart from that 2ab, we have just added R12 here, which is the correlation coefficient between 1 and 2. Why we have added is because we have to analyze the portfolio risk in relation to what both the securities are related. I will give an example and I will explain in detail. First of all, let us try to register this formula in our mind. This says that standard deviation of a portfolio or variance of a portfolio is equal to, you have to take the standard deviation of both of them, multiply with the weight square, add them, and take 2 times of weight 1, weight 2, standard deviation 1, standard deviation 2, multiply with R12. Correct. Now, let us say that in case R is equal to plus 1. In case R is equal to plus 1, then this formula, can I write it like this? Simple, correct? A plus B whole square, because this is A, this is B, and this is 2AB till here. R12 is 1 only already as per this, correct? So this I can write this. If R is equal to minus 1, then can I write this as W1 standard deviation 1? Correct? If R is equal to minus 1, then this becomes A minus B whole square. This was A plus B whole square. Correct? Now, if you see here, you have different risks of the security: risk 1, risk 2, right? Standard deviation 1, standard deviation 2. Now, in case R is plus 1, the portfolio risk will be higher. Correct? The portfolio risk will be higher. But in case R is negative 1, correct? Definitely your portfolio risk will be lower. That means this is the very basic essence of diversification. Once you are trying to diversify anything, always try to put securities in such a manner that their R, which is correlation coefficient, is negatively correlated. So negative correlation helps in diversification. Although this also can help you to diversify to some extent, because you can select weights accordingly, right? Weight 1, weight 2. So weight, higher weight you can give to the lower risk security, and hence overall weight would be lower. But the potential to decrease it to a large extent comes from this, where your securities are, the correlation coefficient of securities is related in such a manner that both of them are negatively correlated. Correct? Hence, at that point of time, your diversification would be highest. Okay? So, this is what the two securities Markovitz portfolio theory says. In case we have two securities, use this. Now, in case of more than two securities, we have to use a matrix approach. That's the easiest one. That we will cover with the question, because there is no point in putting here. That we will cover along with the question. Okay? As of now, for calculating the portfolio risk, we use this formula for two securities. And for more than two, let's understand it from the question itself. Now let us come to the question number 5. A very good question, very interesting question. This will cover almost all the things that we have studied till now. Okay? Yeah. So let's quickly brush up all our concepts that we have done till now using this question. Consider the following information on two stocks A and B. They have given us 2 years returns on A and returns on B, which is 10, 16, 12, 18. You are required to determine the expected return on a portfolio containing A and B in the proportion of 40 and 60%. So this is 40% and this is 60% is what they are saying. Correct? Now let us calculate the expected return for the individual securities first and then portfolio. Correct? Because we don't have expected return for A and B also. So let us start. First of all, expected return. Yeah. Expected return for A is 10 plus 16 divided by 2. So 10 plus 16 divided by 2 is our expected return, simple average, which is 13%. For security B, it is 12 plus 18 divided by 2, which comes as 15%. Okay. So Namita is asking that why we multiply R into securities formula is not clear. Okay. See, Namita, if we don't multiply R, if you ignore R, then you are ignoring the element that there is a relation between two securities, how they move. See, if you just consider formula till here, you ignore R for the moment, you are just plainly doing this. W1, which is weight 1, this formula I'm saying. You are just plainly doing this. You are just multiplying it with the weights, taking a sum and taking a square there. That's not right to do. Why? Because See, that's right in that situation where both the securities are positively correlated. Okay. See, now there are different, there, so for example, okay, let me explain it from here. For example, this is a market. Okay. And this is security one and this is security two. Okay. Now here, what we are doing is we are only studying around the security one and security two. Correct? If we ignore their relative movements here, then one big mistake what you will do is that although you are taking their individual absolute weights and multiplying it with the standard deviation, but there is a possibility or there is a situation where both of them will move in a particular established connected manner. Okay. So if these two move in a particular manner, what is that manner? That is given by R, which is the correlation coefficient. If you ignore this, then you are saying that both of them will always carry the same standard deviation, always carry the same weight. Correct. But that is not true, right? Because if security X is moving in such a manner, Y also will respond to some other manner which is given by R. So hence, if you ignore R, then you are assuming that R is plus 1. But what if R is minus 1? In that case, you have to take a factor saying that since R is minus 1, hence the deviation of 1 and deviation of 2 are negatively correlated, and hence if one increases and the second would decrease. And that is where this formula will come into play. And for the generic formula, hence this is multiplication by R here. Okay. Now expected return we have calculated. What is portfolio? Portfolio is comprised as 13% multiplied by 40%. 40% in security A and 15% on 60% in B. So this comes as 14.2%. So the return on portfolio comes as 14.2%. Okay, students. Now the second part is, so the first part is done. Second part, they are asking standard deviation of return from each of the two stocks. The standard deviation is also very clear here. So let us solve the standard deviation. So the standard deviation is given by A is equal to under root of, I'm just directly taking the values here. I'm not doing the summation separately in a table. Okay, which is 10 minus 13. 13 is what? 13 is the expected return and 10 is the 10 and 16 are the individual returns that are there, correct? Divided by 2. So this will give under root of 9, which is equal to 3. Standard deviation of B similarly will be given as 12 minus 15 square plus 18 minus 15 square divided by 2. Square root of 9 again, which is equal to 3. So both standard deviation of A and standard deviation of B is 3 and 3. The next part is asked as covariance between both the stocks. Standard deviation is done. Now, for calculating the covariance, we need to see the joint variance, right? Which will come as, so between A and B is equal to 10 minus 13, which is this, multiplied by 12 minus 15. Correct? Plus 16 minus 13, which is this, multiplied by 18 minus 15. Correct? This is the covariance, whole divided by 2, which is also 9. So the covariance between A and B is 9, which is the joint variability as per the formula on the historical side that we have studied. Now, the next part, they are asking us to calculate R, correlation coefficient between returns of the two stocks. So the fourth part, R is given by covariance between A and B divided by standard deviation of A, standard deviation of B. That's right. As per the R, which is the correlation coefficient formula. So covariance is 9. Just now we calculated standard deviation of A and B. Both of them are 3 and 3. So that becomes as 1. R is equal to 1. That means, now here is the conclusion. That means both the securities are perfectly positively correlated. Correct? So here if you see the percentage goes up by 6%, here also it goes up by 6%. So hence both of them are perfectly positively correlated. Now last part it is asking is the risk of a portfolio containing A and B in the proportion of 40% and 60%. Now these are two securities. As per the MPT, Markovitz portfolio theory, we can apply the formula for two securities and reach out it and solve the same. Now, let us calculate the portfolio risk. So the portfolio risk is, since in this case R is equal to 1, correct? So we can simply say correct. This is the portfolio risk. So the portfolio is given as 40% multiplied by 3 plus 60% multiplied by 3 whole square. Nine, and the standard deviation of portfolio will be 9 square root, which is also equal to 3. Now students, if you see, you have two securities, both of them have a standard deviation of 3 and 3. Both of them are perfectly positively correlated, and you invest in whatever proportion, 50-50, 40-60, 60-40, 20-80, 80-20, all the proportions will give you standard deviation of the portfolio as 3 only. Because both the securities have individual standard deviation as 3 and both of them are perfectly positively correlated. So there is no chance that one will move in another direction and second one will move another direction at some other extent also. The extent will also be the same, the direction is also the same. Hence your portfolio is also having the same this thing. Hence using R in the formula is very, very, very important. If you ignore R, you are taking an inherent assumption that both the securities are perfectly positively correlated. But in the practical world, it does not happen. Hence, we have to always take R in the formula. Okay, students, I'm giving time for all of you to know. Please keep on interacting as much as possible. Again, I'm requesting to all of you because I can see a very less questions. So please ask whatever you have, in your, or try to at least interact, by giving the answers to what I ask generally. So Namita is asking, sir, in positively correlated securities, price should move in similar direction. Will it mean that the returns also move in same direction? That's right. See, okay, now that's a very good question actually. That's a very elementary question, Namita, I would say. That's a very fundamental question. So let me answer your question. So Namita is asking that in case of positively correlated securities, prices should move in similar direction. Will it mean that their returns will also move in similar direction? That's right. Because I told you that returns is derived from prices only, right? What is return? Return is P1 divided by P0 plus dividend, correct? So these prices only determine the returns, correct? If the prices are higher, return would be higher. Prices are lower, return would be lower. The price movement is higher, the return is higher. The price movement is lower, the return would be lower. I should put it like that, correct? So hence, both of them, so return is dependent on prices. Hence, definitely prices will also move in the positive direction and returns will also move in the same direction. Okay, Namita? So both returns and prices will have a similar impact in case of a perfectly positively correlated security. Okay. Okay, now students, let's come to question number 6. Again, a very, very, very beautiful question which only involves the mind. That's all. It does not involve whatever formulas we have studied till now. It only involves how do you think. This is the discussion that I had with you. Now let us see who cracks this first on this question number 6. I'm waiting for all your responses. This I will wait for your response and then only will proceed for the exact solution. So it says that following is the data regarding 6 securities A, B, C, D, E, and F. There are 6 securities that are placed in front of you. Now imagine you are a portfolio manager. Okay. Imagine yourself as a portfolio manager. You have 6 securities data in front of you. You have been given the returns and you have been given the risk, which is the standard deviation. Now I think you are evolved enough to know that what does a risk mean and what does a return mean and how those have been calculated. Assuming 3 will have to be selected. Now you are also given a limitation as a portfolio manager that out of these 6, you have to only select 3. State which ones will be picked. Now students, I expect responses from you. Now try whatever comes to your mind, any fuzzy logic, anything. This is whatever we have discussed till now. With that also, if something comes across to you, just help me understand which one would be the security that you would select out of it. I'm just writing the. See, you have A security where return is this much, B is also there, C, D, E, F. You have given 6 securities. Now, which all securities would you select? Because you have to select only 3 securities. The objective of a portfolio manager should be the return is highest and the risk is lowest. That is how the portfolio manager should think. Correct? Okay, let me make this step a bit easier. Let me ask you, if you see in this, all the securities, there is one commonality, right? In some of the securities. For example, if you take A, B, and F, A, B, and F, that's the way how we should tackle this is A, B, and F have the highest, have the similar return, correct? And there is a risk also that is there, 4, 5, and 6. So for this A, you have 8, 8, 8, 4, 5, 6. Now, can you tell me that which security would you select out of these 3? All of them are giving you the same return, but the risk profile is very much different. Of the 3, A offers you 4, B gives you a 5 risk, and F is a 6 risk. Perfect. Now I'm getting some answers. Jitendra, thank you very much. ACE. ACE. Perfect, Jitendra. Bang on the point. We'll come to your solution, Jitendra. But your answer is correct. We'll go step by step. Namita, A, B, E. A, B, and E. Okay, Namita, you are right to some extent. Let us see. Sairam, A, B, and F. A, B, and F. Okay. Sairam, that was a good attempt. But okay, now let us go step by step and think through it. The student keep on posting the answers as and when you think, right? So, see, the approach here of a portfolio manager is you are given these 6 random securities. First of all, okay, let us try to group securities in some of the smaller groups. So first group I have created this one in which the returns are same, the standard deviation is different. Now, perfect. Namita is saying A, Harshad is saying A, Bharti is saying A. Very good. All of you are thinking on a very great line. So we are saying that we will select A from this. That's perfect. Namita, you are right. Harshad, you are right. Bharti, you are right. Why we are saying A is because A has the lowest standard deviation. Okay. Now that means V and F are as of now ruled out. These are ruled out from my portfolio. Correct? Think that you are a portfolio manager. Now A is selected. I will say that's let's A. Now second group. Can we make second group here? See now in terms of return, is there any similar thing? No. Return there is no similar thing. Now let us make second group. Let's combine having risk together. Same risk together. So 4 is also having A and 4 is also there in D. Right? Nothing else as of now is 4. So we will take second group of A and D. Now, students, come on, tell me between A and D, which one you prefer? A, 8, 4, 4, 4. Return, risk. So between A and D, now A have a higher return of 8, D have a low return of 4. Risk is same in both of them. For taking the same amount of risk, which security would you prefer, A or D? I'm waiting for your responses. This is a actually simple one. Between A, B, and F also, the correct responses came. Right. Again, it's A. Perfect. So D is again ruled out. Why? Because the A is having higher return and the same risk. Correct? Now let us go to the third point, third grouping. So as of now, D is ruled out. Correct? B and F, let us see now. So B having a standard deviation of 5 and E also having a standard deviation of 5. Both of them are having 5 and 5. Now let's make a second group of this. B and E. Standard deviation is 5, 5. Returns are how much? 8 and 9. Perfect. Miss Tika Pandey, A will be preferred. Bharti, A will be preferred. Perfect. Thank you. So 8 and 9, now we will prefer E. B is ruled out here, correct? Again, for a simple reason, 8 is lower than 9, correct? So E is preferred. Now let us conclude. A is the final outcome here. A is the final outcome here. B is the final outcome here, correct? Sorry, not B, E. Sorry. E is the final outcome here because E is having higher, correct? Now since A and E are there as per all the three groups, so definitely our two selections will be A and E, correct? Now let us see what all things are ruled out. E we have selected, A we have selected. Now F is already ruled out, B is also ruled out. Left is C. Now C is having 12 return and 12 standard deviation. If you see, highest return and highest risk. Now this is security is okay for that kind of an investor who wants to invest for a very high return and who is also willing to take a very high risk. Correct. But still, since this is not fitting in any other group and the return is higher compared to the other one, so and 3 is what we have to select. 3 is what we have to select. So we are selecting C also. This is our final selection. Harshad Goel is saying A, B, and E. So B actually, Harshad, we have ruled out here because B against B and E is better because E is giving you higher return and at the same standard deviation. So Harshad, please note it. Only B is not there. Namita is saying E is perfect. Yeah. So A, E, and C. This is our final selection. Now, as a portfolio manager, you have devised a E, and C, and you have basically, see, if you see, you have not done any operation here. You have not done any statistical operation here. You have not applied any formula here. You have not done anything. You have just went on through plain logics to arrive which security will you pick. Correct? Now, the second point, assuming perfect correlation. Now, what does perfect correlation mean here? Please respond. I would expect some answers. Let me give you here a perfect correlation. Okay, I'm giving you 4 options. A, B, C, D. Tell me which option is perfect correlation means. Perfect correlation means it is a covariance is equal to +1. Covariance is equal to -1. R is equal to +1. R is equal to -1. Out of A, B, C, D, tell me through pinging that what does the perfect correlation means? Is it covariance +1, covariance -1, R +1, R -1, A, B, C, D? Okay, Jitendra is saying in these 3, A, C, and E, which one to be selected if only one has to be selected? Good question. For that, you need to take the help of the concepts that we are studying. Okay, now, if you ask me, Jitendra, okay, what I will do is A, E, and C, let us plot their risks and returns. 8, 12, and 9. 8, 9, and 12. Risk is 4, 12, and 5. 4, 5, 12. These are their risks. If you ask me, I will just do a very simple operation. 8 divided by 4. That means I am calculating return per 1 unit of risk. I will do here 9 by 5, 12 by 12. So 8 by 4 comes as 2. 9 by 5 comes as 1.8. 12 by 12 comes as 1. Which one is the highest, Jitendra? 2 is the highest. So that means for 1 unit of risk that you are taking, A security is giving you the highest return. So you should select A. Okay, Jitendra. This is again based on the logic. I have not used any, again, standard deviation, covariance, variance, R, nothing is used here. This is again pure based on the logic. I want logics to be built first, right? Okay, Jitendra. Harshad is asking, but in AEC return is 29% and risk is 21, while ABE return is 25. No. Harshad, again, see, Harshad, I think you are thinking in the right direction, Harshad, but the point is the risk you cannot take as an addition. Wait. So, Harshad, please wait and listen to me very carefully. AEC, if you see, you will not invest 1 by 3, 1 by 3, 1 by 3 in all 3 of them. What you have done is you have taken a total risk and total standard deviation that you can't take. Because we have studied just now how to calculate portfolio risk and how to calculate portfolio return. See, portfolio return is we have to take the weights and multiply. If you are just adding the return, you are taking an inherent assumption that you are investing 1 by 3, 1 by 3, 1 by 3 in all the 3. But that is not the case, right? We are not investing like that. There are different proportions. There can be different proportions. That is what, as a portfolio manager, I have to do, right? if I have to invest equally, then there is no point of me handling the portfolio, correct? So that is one. Second is, even in risk, we are not multiplying standard deviation 1, 2, 3 to arrive at the portfolio standard deviation. No, there is a proper formula to arrive at, in which we use R, in which we use weight, in which we use standard deviation. Okay, Harshad. So we can't say that the cumulative risk is just by adding it. Sorry. Where is that now? Yeah. So we were discussing this. So we can't say that cumulative risk is just by adding it. Correct? I hope, Harshad, my point is clear to you. Harshad. Okay. So hence I'm saying, as of now, we are not evaluating a portfolio. Again, Harshad, I'm coming to the same point. We are not evaluating a portfolio. We are just picking the securities. Which securities will maximize our portfolio return and minimize our portfolio risk. Correct? Shailesh, R is equal to 1. Perfect, Shailesh. Good. Sairam, C, perfect, which is R is equal to plus 1. I asked this question to all of you. Now the responses are coming. Perfect correlation is 1. Daksh Agrawal is saying perfect correlation R positive 1. Perfect. Namita is saying, sir, can we take two securities having same risk? So in practical life, why we are not taking A, B, E as our portfolio? Okay, see, Namita, if we take two, okay, now you tell me on a standalone basis, if someone tells you between B and E, there is a same risk involved between B and E, correct? But the return is higher in E. So will you take both the options, or you will take only E option? I mean, will you take only E to be taken, or will you take both? If you ask me, I will not take B, because E is superior than B. For the same level of risk, I am getting 1% extra return. Correct? Okay, Namita. So for the same level of risk, we are getting higher return. I will rule out B from my picking. I will only take E. Okay. I hope, Jitendra, I have answered your question on which one security to be selected. Namita, your answers, I hope I have done. And thank you all of you for responding. That makes really lively about this session, right? Okay. The students coming back. Now, all of you have perfectly understood what is a perfect correlation. Okay. So yes, there is a perfect correlation, which is called as R is equal to plus 1. Now, the second part is saying, assuming perfect correlation, show whether it is preferable to invest 75% in A and 25% in C, or just read the words very carefully, or to invest 100% in E. Now, what they are saying is, there are two things that you can see. So first case, 75%, 25%. 75% A, 25% C. Okay. And E is 100%. This is the second portfolio that they are saying. I hope this is clear till now. Now they are asking us to calculate the risk and return between both of them. Okay. Now, students, if you see return, let us calculate the return, which is the easier part. A and C, what is the return? So 75% will be applied on A's return. So A is returning how much? 8%. 25% multiplied by 12. Okay, Harshad. So you're saying that A, B, and E are still better. Okay, let me check. A, B, and E. So if you're saying that C has a higher standard deviation and let's take a lower standard deviation and a higher return, then definitely from that possibility, what you're saying is yes. But see, even this conclusion that we have derived, Harshad, okay, A, E, and C. I'm commenting on our conclusion that we have derived, A, E, and C. What I'm saying is, basis the logics and everything, this is right. But technically, if you ask me, A, B, C, D, and E, and F. So there is a sharp optimal portfolio. There is a proper theory that we are going to study in our next session. In that, we are going to study how to select the securities on a proper methodological, mathematical, statistical way. Okay. So it might be that in that A, B, and E will come, Harshad. Okay, but I just wanted to set here is that what we going by the pure logics as of now is what it is throwing out to be. Okay. Now, if we see this, it is how much 9% is return. E is already plain vanilla return that is given to us. There is no calculation required in E. So it's 9. Okay. Now coming to the risk. Now risk, students, if you see, this is a portfolio risk between A and C. These are two securities between A and C. Two securities have to be calculated how? See, if R is equal to +1, which is the case here as well, because they have told you that it is perfectly correlated. So you don't have to apply anything, but just take weight 1, standard deviation 1, weight 2, standard deviation 2, take a square of this. This is the variance of portfolio that will come. Correct? So 75% multiplied by standard deviation of A is how much? 4. Plus 25% standard deviation of the second security is 12. So there is a total 6. So standard deviation P square is equal to 6 square. So standard deviation of portfolio is 6 here. Okay. Now E is what? E here is standard deviation is already given as 9. Now, sorry, standard deviation is given as 5. Sorry, these are 5. Now you tell me between both of these options, A, C, and E, you have two options, right? Both of them are giving you 99%. But which one is offering you a lower risk? In this case, you are getting 6, and in this case, you are getting 5. So you will go and prefer to invest 100% in E. Okay? Because this situation was given us through this question, whether A, C, or whether E, which one you invest. So we will invest in E because E is giving us the same level of return with a lower this thing. Okay, Jitendra is saying which is better understand way of risk. Okay, so Jitendra, see, as I told you that in this question specifically was based on a specific situation and asked you to apply the simple plain logics. But if you ask me, the technical way, the results will be better, which is the Sharpe's optimal portfolio that we will see. We will solve one practical question also. In that also, we will be given some 6-7 securities. We have to select the securities, and that model will tell you how much to invest in the securities also. So that model is very powerful model that will tell you which security you should pick and what amount you should invest. Okay, Jitendra. But this was just to brush up on our logical part. Okay. See, in the starting of the portfolio, I told you as a portfolio manager, you have to take 3 things in this. One is that which security, what amount, and evaluation of a portfolio. Till now, we have analyzed a lot on what is a security, what is a risk and return for a security. Similarly, for a portfolio, what is a risk and return and how it works like. Now, I am asking one question actually, which I have not clarified till now, right? But basis the understanding, let us see if someone is able to answer that. Okay, now this is what my question is. Okay, this is what my question is. Please listen it very carefully. Standard deviation. Sorry. Okay, let me take the above example only. In this standard deviation for a portfolio was coming out how much? It's coming as 6, right? Okay, just a second. Sairam, you're asking how taken weights. Weights are given in question, Sairam. Just check the question. Question says that 75% in A, 25% in C, and 100% in E. So there are two cases, 100% in E, 75 and 25 in A or C. A and C, sorry. Okay, so that is taken from the question. Now my question is, students, please listen very carefully. This is a very, again, this is a very basic question, correct? Now standard deviation, can you tell me that what is the unit of standard deviation? We are saying standard deviation is 6. Can you tell me what does this 6 mean? Is this 6 absolute number, or this 6 is 6 percentage, 0.06? What do you feel it is? Standard deviation, what do you feel it is? So is it that, so by this 6, can I conclude that, now for example, here also risk standard deviation is given 4, 5, 12, 4, 5, 6. Now what does this signify? How, whatever we have calculated till now in terms of standard deviation, what is the unit of measurement of that standard deviation? What is the unit of that standard deviation? It's very easy, but I want to derive one logic out of it. That's why I'm asking. Come on, think and then post your answers. My students, I think all of you should try to attempt this. What is the unit of measurement of a standard deviation? Simple question. Whether it is absolute or it is percentage. Okay, let me put it like that. Whether it is absolute or is it a percentage? There are two options given to you. Is standard deviation is an absolute calculation or it calculates the percentage? Because a lot of us gets confused actually what it is, whether it is an absolute or whether it is a percentage. Great. Harshad is saying percentage. Namita is saying absolute. Bharti is saying return is also in percentage. Perfect, Bharti. I think that's the kind of response. The unit of is percentage in the given case. Perfect, Daksh. I think all of you have clearly attempted it very good. Now, Namita, it's absolute. Okay. So see, I'll just answer this question. What I've asked. See, you have not to take don't remember it. Okay. Always see that if you are calculating standard deviation of what input, see, I'm just giving a very beautiful logic. What is your input here to calculate the standard deviation? And there is an output. Correct. There is an input to calculate standard deviation. Standard deviation is a model, is a formula which gives you output. Now the input that you are using here is return percentage. Definitely the output will also be in percentage only. Shailesh, you are saying absolute plus, please listen here. What I'm trying to explain you is, okay, you will never get confused from now on. What I'm trying to say is that always try to see if you are calculating the standard deviation on what input. The input is return percentage. The output will also be percentage. In case you're calculating the standard deviation on prices, there can be a standard deviation on prices also, right? This entire portfolio management, we are doing the standard deviation on percentages because we're talking about return percentages. And in the questions where prices are given, we are converting them to return percentages and then calculating the standard deviation. Correct? That is what portfolio management asks us to do. But in case you are finding a standard deviation on prices, then in case of these prices, the standard deviation will be absolute. Because price is absolute, standard deviation will also be absolute. You're getting my point? I hope you're able to understand the logic behind it. Because you are doing the standard deviation operation on input, which is the percentage, hence the output is also percentage. Now this gives me what I'm trying to explain you. So this standard deviation of a portfolio is 6%. That means on an average the return is 9%. It can go to -6 plus 6. -6 is 3%. 9 minus 6 is 3%. 9 plus 6 is 15%. So this is the lower range, this is the upper range. Finish. You as a portfolio manager know that this portfolio will give you 9% on an average, but yes, there is a possibility that it can go down up to 3% and can go up to 15%. Similarly, if you have price, you have average prices, right? The way you have average return, you have average prices. You have an average price of 9 rupee, or I'm taking 90 rupee here. And you calculate the standard deviation on price. The standard deviation comes as plus minus 15. It means that the price can go down up to minus 15, which is 75, and it can go up to plus 15, which is 105. I think I am able to clearly explain you that standard deviation, always analyze it that on what input you are doing the operation to arrive at the output. Namita is saying that please explain by writing the standard deviation formula. Okay, Namita, I will just put the standard deviation formula. We have discussed the standard deviation formula here only. This is the standard deviation formula. X minus X, X bar. So there X and X bar are what? These are the return percentages. Correct? Hence your output also is in percentage only. If you want to, okay, you have a data of 10 students who are having different heights in centimeter, then your X will be in centimeter and your standard deviation will also be in centimeter. You're getting my point? I hope I'm able to clear it out. Okay. Now let us touch upon the last topic for today, which is the efficient frontier. Now students, please listen to this concept very carefully, because this is a very beautiful concept derived by Markovitz again. So this is a part of Markovitz portfolio theory. Okay. Now what Markovitz says is that there are different combination of portfolios available in a market, right? That you can make. Just now we have tried and tested by making AC ones, E ones, right? Similarly, you can take any combination out of this six securities that we have. A, B, C you can take and do the investment. B, C, D you can take, do the investment. D, E, F you can take, do the investment. A, E, F, A, D, F, whatever combination, whatever number of securities you want to take, you take. And then plot all the possible portfolio combinations. Plot all the possible portfolio combinations on a chart. And this chart looks like this. On x-axis you have risk, which is standard deviation. On y-axis you have return, which is again percentage. Now I hope the students of this session know that this risk is also in percentage only, correct? Because we are talking about standard deviation of the return. Okay. Now the return is in percentage, correct? Now he's saying you plot all these combinations here. Okay. See, for a given combination, there will be a return and there will be a risk. So you see that where is the return and risk getting collided? Put a dot there. Okay. So if you do that, then automatically there will be a outer line that will come like this. Okay. Now So this means that higher risk, higher return. Correct. So this will mean that highest risk and highest return. Similarly, this will mean that some lower risk, lower return. Because if you see here, the return is lesser than this. Correct. So I am putting A and B. So A here is not the security. A here is the portfolio itself. So we have plotted this, all the combination of portfolios on this chart. Okay. Now A is a portfolio, B is a portfolio. Similarly, C, D. And similarly, let's say here is a F portfolio, G portfolio, H portfolio, something like this. There are a lot of portfolios. So what Markovitz says is, and which is very logical also, he says that if you are going to look for the most efficient portfolio, which will be that? So he says that once you plot all the portfolios here, this frontier that is coming up here, this frontier, this frontier that I'm putting, on which A, C, D, and B portfolios are there, these are your most efficient portfolios because these are better than others. In the sense, either they will give you a higher return for the same risk, or they will give you a lower risk for the same return. Now explain how. Now this is a B and this is a F. Okay, F have a higher risk, correct? Because the risk axis is higher, the return is same. B and F is offering the same return. The return is y axis, right? So for the same return, B is better than F, correct? That's proved. Now coming to this C and F. C and F. So for the same risks, both C and F have the same risk, correct? But the return for C is higher than F. Okay. So hence, you can try and test this frontier against this other combinations. It will be always efficient. Hence, it is called as efficient frontier, which includes all the portfolios. Now, if you see return, there is a risk-free rate of return, correct? Risk-free rate of return means that is available on government bonds in the market. There is no risk in that. Now, what he also says is, if you take the risk-free rate of return, because let's say risk-free rate of return is 10% here, for example, you take that and you draw a line touching frontier. You draw a line touching frontier in such a way that it only touches and goes. So wherever it will touch the frontier, okay, which is B point, this is the market equilibrium. Market portfolio, which is BSE, NSE, will be this B. Market will always operate on B. Okay, this is what his hypothesis says it. Okay, students, so this is, I am touching upon the efficient frontier and efficient portfolio as per the Markovitz theory. This part we will again touch back in the capital market theory, the capital market line and capital market theory in the next session. But I just wanted to clear this graph to all of you so that this is what it is. Okay, I hope this is clear. Now let us take 2 minutes to see what all things we have done to conclude and wrap up today's session. So we started with portfolio management. We said that as a portfolio manager, we have to take certain decisions with security, what amount, and then portfolio evaluation. In terms of a security, we will take only two relevant characteristics. One is the return and one is the risk. For return and risk, we studied how to calculate it. Risk is nothing but the standard deviation. Return is the actual and the expected return that we are expecting out of it. We also seen that what is the difference between historical and futuristic data that will help you to apply that, which formula you have to apply. In case of a futuristic data, use of probabilities is there. Historical data is actually what has happened. Then, questions I am leaving as of now. Then we also studied that what is the difference between, now risk we have bifurcated into systematic and unsystematic. Systematic is that part which is generic macro, unsystematic is specific micro. Unsystematic, we said that it is a diversifiable risk. We can diversify that because it is specific to a company. How we can diversify that? By investing in another company which is negatively correlated with that company, correct? Then we studied variance, covariance, and using covariance, we also studied the correlation coefficient. Now, using all this, we have also studied how to calculate the beta that is used in the calculation of systematic risk. Okay, this is the beta that is used in the calculation of systematic risk, and that we have studied using correlation and regression techniques. Correlation studies the movement between two, and we are using correlation coefficient, covariance, all the things in correlation formula. But regression, on the other hand, always assumes that there is a dependent variable and there is an independent variable. Dependent is dependent on independent variable. Independent variable will move first, and then dependent will move in the other direction. Okay, and this formula also I told you is very, very important. Then, as a next step, we have studied the portfolio return and risk, how to calculate the portfolio return and portfolio risk. That is just multiplying with the weightages. But the risk is a critical element, because risk we cannot ignore R. R we will have to always see, because R will play a major role in how the risk is defined. So more than 3 securities we will cover in the next session. And that's how we have finalized our efficient frontier for seeing what is the Markovitz portfolio theory. Now, Namita is saying, what does market equilibrium mean? Okay, market equilibrium, you forget the word market equilibrium. You always say that market is always on B, which is all the BSE, NSE, or any other market which is operating, it will be always on B, which is the line, this risk-free rate of return line touching on y-axis will touch the efficient frontier always. That, see, because for us, the efficient frontier is A also, B also, C also, D also, correct? Because those all are appearing in that frontier, correct? But the market will always be at B, where this risk-free rate of return line cuts B. Okay, this is what Markovitz have concluded and said. Okay, students, so it was very nice discussing these topics with you. We'll connect back again on the future part, the next part of this portfolio management. So till that time, please do revise these sessions. Please do practice the practical questions as well. We'll meet you in the next session. Thank you. Stay safe. Have a nice day ahead.